Well, I think everybody coming back from the Chinese holiday did give them a slow start. But I think what it really happened is everybody is trying to convert all the numbers from all the other spaces in an economy perspective, how we would probably be able to reflect back on the stock market. I mean, personally, from what I'm seeing is like a 7.6% year-on-year increase in domestic tourism during the Lunar New Year holiday had failed the boost stocks on the first day of trading of the year. The tourism has been a very, very good kicker for the Chinese economy for the last couple of years, and everybody was thinking this would continue the assistance in the stock market. I think the overall problem here is the U.S. and China trade war, which is basically affecting a lot of the internal consumer market, which again had a lot of effect on a lot of stocks right now in China. I think that's probably one of the problems.
So holiday spending for the Lunar New Year, we have some preliminary figures. They say they grew by about 8.5%. Now that looks good on the surface, but the folks at Bloomberg said that this is the slowest growth rate for Chinese New Year holiday spending since 2002. What do you make of the numbers? Are they optimistic from where you're sitting, or are they laden with worry?
Well, I think everybody has slowed down on the local spending. I mean, basically, China has been spending quite a bit of amount of money in China internally for the last couple of years. If you read the numbers last year, is just amazing, even just through the online market. So what I'm thinking is, first of all, I think everybody has been over-expecting what China is going to look like. But the internal market right now here in China is let's put our money to something that's going to basically make money for us, rather than spending it onto some consumer goods, which is going to be like a normal retailer thinking. So the retailer consumer now is more intelligent and becoming more smart when where they put their money is. So I think they're switching gear to how they use the money now. It's not because they're not using the money; they're using the money in a different way.
And Peter, we're also seeing that there's a lot of small cap stocks in China that are jumping today, especially down in Shenzhen. Why do you think that's the case? Is this just a matter of rotation for investors where they're going from big cap to small cap? Or is there something else that's perhaps giving them a little bit more of a perk in today's trading session?
Well, I think the small cap stocks has always been an addicted section for the risk takers, which is usually the smaller investors in the market, whereby now some of the risk takers now are switching to the big cap stocks because, they probably wanted to go a little bit more conservative in the beginning of the year and then wait it out and see how the market will come out, and then probably they will switch again once they probably see some of the favorite stocks coming back into the game.
So, Peter, Hong Kong markets also recovering from a Friday slump today. They seem to be in the green. But I did want to talk about the residential space in Hong Kong. It seems that there's a piece of news from the South China Morning Post where they're saying that a big piece of residential land in the Tai Po area fetched more bids than anticipated. They have 10 bidders, and some of the who's who developers in Hong Kong, among those throwing their hat into the game. Sun Hung Kai, CK Asset, Henderson Land, Sino Land, Wheelock, you name it, they're there. And there's a number of them out there. And some are saying that this is possibly a sign that there's still some spunk in the Hong Kong property market, despite some of the naysayers who are saying that there might be some headwinds this year. From where you're sitting, what do you make of this particular bid and what it tells you about the health of the Hong Kong real estate sector?
Well, I mean, a lot of the investment banks right now in Hong Kong are expecting a rise up to around 15% in the property market, probably in the coming up April to December. However, I think we have experienced a realistic drop last year coming in from the Hong Kong home prices. Basically, from what I'm gathering is a lot of the property company has been relying on buyers from China strong bias from China for the last couple of years, which is slowing down because of the problem with moving the money from China into Hong Kong. So, however, I mean, Hong Kong has been made out of property companies building a lot of properties for the last 30 years, which has sustained the growth of Hong Kong very, very consistently. All the Hong Kong property company would probably want to continue to tell people, hey, let's continue this growth. And I don't think anybody would want to tell people or tell the market about that they have no faith in Hong Kong. So I think this particular incident is showing that these property companies are working together to make Hong Kong a better property investment arena and continue to have Hong Kong to be a good property investment arena for the investors all around Asia.
And but from where Silverbear is sitting, do you think that it's still a good property market? There's still a lot of upside in the property market in Hong Kong.
From Silverbear point of view, actually, we're moving our investment a little bit away from the property market in Hong Kong 2 years ago. So what we've been working on is we are moving our capital into consumer goods, which is China-based, but we are relocating them in a hybrid area whereby it's enjoying tax treaties between China and U.S. So this is actually what we've been doing for the last 2 years. Not saying that we have no faith in Hong Kong. We're still keeping some of our portfolios in Hong Kong, but we're slowing down with what we're doing in Hong Kong and on property wise until we can see how we can switch our portfolio into a more infrastructure type investment in Hong Kong.
All right. Peter, let's switch over now to the ongoing U.S.-China trade talks. It seems that the March 1 deadline for the trade truce is approaching, and talks in Beijing are going to resume. You have Robert Lighthizer, the U.S. Trade Representative, and Stephen Mnuchin, the U.S. Trade Secretary, is set to meet with Vice Premier Liu He over the course of this week. Can you talk to us about what you guys are, how crucial this is for markets on either side of the Pacific?
Well, this is a very good topic. Actually, we have a full team looking into the situation every day because we have so much investment in the U.S. as well. Now, let's look at the downside. If there's no agreement reached by March 2nd, I think another 1 million jobs will be lost in the U.S. alone. So our thinking from this end is U.S. is equally wanted to come to an agreement with China in this space currently. So our prediction is that some way or somehow this two big power giant leader in the world has to come to some sort of agreement whereby it's not going to hurt each other anymore.
If the worst happens, or if no deal is achieved, what do you think this might spell for markets across Asia, and especially markets here in Singapore, which saw its strong January start to the year put to the test in recent trading sessions?
Well, I think if no deal is reached by the U.S. and China, I think that there will be quite a bit of negative effect on the Hong Kong stock market. I think most of the investors, financiers will be looking for an alternative market near Hong Kong, which is probably Singapore, because I think Singapore is the next attractive market for these investors.
Okay.
If Hong Kong decided not to perform because of this disagreement between U.S. and China.
And finally, Peter, over at Silverbear, if in the best case scenario that they come to an agreement in the coming weeks, and in the worst case scenario that they don't come to an agreement in the coming weeks, how are you guys positioning yourselves or protecting yourselves from either the upside or the downside risk of either scenario?
We just in case it went well, which we think we will, then we'll be basically restructuring our Hong Kong portfolio and China portfolio a bit, whereby we'll buy a little bit more asset-based stocks. So cater towards the real estate style a little bit because it's on the low side right now. So buying these stocks would be our strategy. If it doesn't go well, then we will continue to look into manufacturers who has a relocation strategy whereby, as I said, they'd be moving their manufacturer into a hybrid position like Egypt, who's enjoying free taxes into U.S. with a very friendly relationship with China as well. Because I think the world will not stop spinning because of the disagreement. So I think we'll be looking into consumer goods, but with a hybrid strategy whereby they have been relocating their manufacturing facilities that would enjoy a hybrid tax treaty advantage.
All right, that's Peter Chun, Managing Director over at Silverbear Capital. We thank you for your time with us.